Welcome to the Deep Dive. We're here to cut through the noise on complex market stories, and today, well, we're digging into Repay Holdings Corporation, that's RAAY.
Yep.
Their latest quarterly call just dropped, and management's really pushing this narrative about getting back on track, accelerating growth.
Right, and that's the mission today, isn't it? To figure out if that story holds water. Because, the numbers this quarter, they're kind of all over the place.
How so?
Well, on one hand, Repay is honestly a cash-generating beast. But the market, it seems to think the growth story's falling apart.
Okay.
So we got to slice through all the accounting adjustments, the non-GAAP stuff, and see if this reacceleration claim is, real or just talk.
All right, let's start with the basics then. The Q2 2025 numbers, top-line results.
Actually looked okay, slightly better than expected, actually.
Right.
Revenue came in at $75.6 million. That beat the consensus by about, $2 million?
Yeah, about $2 million, but still, that was only a 1% increase compared to last year. Pretty modest.
Very modest. And then adjusted EPS, earnings per share, that was $1.20, pretty much exactly what the street expected.
So far, so. Fine, nothing too alarming there.
But here's where it gets confusing. And this is probably what caused that little dip in the stock after hours, the gap between those adjusted numbers and the official GAAP numbers.
JAP, generally accepted accounting principles.
Exactly. While adjusted EPS was that 20 cents, the reported GAAP EPS was, wait for it, negative $1.15.
Wow. Okay. Yeah, that's a massive difference. $1.35 swing per share. What on earth caused that?
It boils down to one single item, thankfully, and it's non-cash, which is key.
Non-cash. Okay.
They took a $103.8 million goodwill impairment charge. It was specifically in their consumer payment segment.
Goodwill impairment. So basically they're saying an asset probably from an old acquisition in that consumer space isn't worth what they thought it was.
Precisely. Think of it like spring cleaning for the balance sheet. They bought something years ago, paid a premium that's the goodwill, and now they're officially admitting, yeah, we kind of overpaid, or it's not delivering like we expected.
So management's line is, this isn't about current operational problems today. It's fixing a past accounting issue.
That's the argument. It's a historical adjustment, not cash bleeding out the door now. And, that's super important because if you look past that headline, GAAP loss.
The actual business operations.
Yeah, the underlying ability to make money, it's still incredibly strong. Adjusted EBITDA was $31.8 million. That's a 42% margin. Really healthy.
42% margin is good. And you mentioned cash flow earlier.
Oh, yeah. This is the stunner. Free cash flow, FCF, hit $22.6 million, and the conversion rate.
How much of their earnings turned into actual cash they can spend?
An amazing 71%. Seriously, that FCF conversion is almost off the charts in this sector. They print cash incredibly efficiently. It's like an ATM.
Okay. A cash machine, 71% FCF conversion, strong EBITDA margins. But, and it's a big but, that top-line growth looks weak.
Right.
Reported gross profit actually declined 2% year over year. That's their main profit metric, isn't it?
It is.
So how do they possibly square that circle, claiming growth acceleration when the core profit figure is shrinking?
Okay, yeah, this is where their whole narrative really hinges. They spent a lot of time on the call explaining this. They blame lapping headwinds.
Industry speak for tough comparisons to last year?
Basically, yeah. Two big things from last year are making this year look worse than it maybe is. One was some client losses they already told everyone about.
Okay, known issue.
And the other was a big chunk of revenue from political media spending in 2024, which obviously isn't repeating this year.
Right, election year effect. So their argument is if you mentally pull those temporary factors out...
Exactly. If you normalize the numbers, as they put it, gross profit didn't shrink. Yeah. It actually increased year over year in the single digits.
Single digits, okay? And that single digit growth is the baseline they're using to promise getting back to high single, maybe low double digit growth later this year.
That's the plan. That's the foundation for the Q4 acceleration story.
I gotta say though, whenever a company tells me to ignore a massive GAAP loss and focus only on normalized numbers, I get a little twitchy.
Understandable. Skepticism is warranted.
Is this just clever storytelling, or did they give any real proof points for this underlying growth?
They did try to break it down. They gave some segment detail. So business payments, for example. Yeah. The reported numbers looked rough, but they claimed that if you took out the hit from that specific client loss they mentioned and the political ad spending comparison, the underlying GP growth in business payments would have actually been in the double digits.
Double digits. Okay, that is a big difference from the reported figures. What about consumer payments?
There, the drag from those client roll-offs was smaller. They said about 3 percentage points. So the overall picture they're painting is, yes, things slowed, but the core business is still moving forward underneath these temporary headwinds.
Okay, let's go back to that goodwill write-down for a second.
Yeah.
Even if it's non-cash and historical, $103 million is a lot of money.
It is.
Doesn't that suggest they seriously overpaid for whatever that consumer asset was back in the day? Isn't that a knock on their past M&A judgment?
Oh, absolutely. It definitely raises questions about past capital allocation, no doubt about it. But, for someone looking at the stock today...
What matters now?
Right. What matters is whether the current operational engine, that cash generation, still works. And it seems to. They're kind of cleaning the slate, saying, okay, that was then, this is now, let's focus on the future profit.
Speaking of the future and cleaning slates, let's talk capital allocation. The market is definitely worried about that $220 million convertible note. It's coming due relatively soon, February 2026.
Yeah, that's the big financial overhang. Besides hitting those growth targets, it's definitely on everyone's radar.
What's the plan? They've been buying back stock, right? Used about $38 million year to date.
They have, which, signals they think the stock is cheap. But it also uses cash.
Cash they might need for the debt.
Potentially. They said their priority is using cash on hand first to pay down that note.
Yeah.
But we'll get back to whether that's enough later. For now, they're balancing buybacks, investing in the business, and keeping an eye on that 2026 maturity.
Okay, so that brings us to the strategy. If they're promising this sequential improvement, this return to growth, where's it supposed to come from? What's actually driving momentum?
They highlighted a couple of things. They've kept investing in their enterprise sales force and customer support.
Okay.
And they say that's leading to, quote, healthy growing sales pipelines. So the idea is those investments are the inputs and the output should be that growth acceleration in the second half.
Makes sense. Any product news helping that? They mentioned MeridianLink integration being expanded.
Yeah, that's actually pretty significant. MeridianLink is a big player in the software ecosystem for credit unions and other financial institutions.
A key vertical for Repay.
Absolutely. So this deeper integration is designed to make it easier and faster for those clients to get set up, fund accounts, things like that. It builds on their network. They already have like 185 plus software partners.
Did they show any results from that focus yet?
They did. They specifically mentioned adding 10 new credit union clients just in Q2. That brings their total up to 353 credit unions. So it looks like that focus strategy is bearing some fruit.
And on the leadership front, getting a new CFO should help with stability too, right?
Definitely a positive. Robert Hauser is coming in as CFO in September. He's got a deep background in payments, worked in complex companies. Seems like the right kind of experience for where Repay is right now, trying to prove out this growth story.
Okay, looking at the segments again. Business payments. They admitted accounts receivable, AR, was a bit soft, but they're pushing hard on accounts payable, AP. Why that shift?
Smart, strategically and financially. AR is basically just helping clients collect money owed to them. AP is managing how clients pay their own suppliers.
And that's better business.
Generally, yes. AP automation tends to be higher margin. It's stickier, harder for a client to rip out once it's in place. Plus, it lets Repay make money off the actual payment flows, things like enhanced ACH or earning interest, float income on the money moving through their system.
Right, monetizing the payments themselves. Does that show up anywhere else?
Yeah, look at their supplier network. That's key for AP. It grew 47% year over year. They now have over 440,000 suppliers connected.
Wow, 47% growth.
Yeah. The bigger that network gets, the more valuable it is, the easier it is to onboard new clients who want to pay those suppliers electronically. It's all about those network effects in B2B payments.
Okay, so pulling it all together, we have decent underlying operations masked by some headwinds and a big accounting charge. We have a focus on growth areas like AP and credit unions, but the market's still skeptical.
Exactly. It all comes down to execution in the second half of this year. The market has basically said, show me. It's a total wait for proof situation.
So what's the final exam? What exactly does management need to deliver to win back trust? Let's nail down those targets.
Okay, first hurdle, Q3. They need to show that sequential underlying gross profit growth they talked about, just moving things in the right direction quarter over quarter.
That's step one. The big test is Q4.
That's the make or break quarter. They need to hit high single digit, maybe low double digit underlying gross profit growth in Q4.
Compared to the prior year, normalized.
Right, on that normalized basis. If they hit that, the whole story changes. The narrative shifts from turnaround to growth is back. They also said FCF conversion should accelerate again, get above 60% in Q4.
So hitting that Q4 growth number is really the main catalyst needed to get the stock moving.
Absolutely. That's what could unlock the value that seems trapped by the current skepticism.
Okay, but let's revisit that debt quickly. The $220 million convertible note due Feb 26. You said they'd use cash on hand first. How much cash do they have?
They reported $163 million in cash at the end of Q2.
So, not enough to cover the full $220 million.
Correct. And they confirmed this on the call. They explicitly stated they would need to draw down on their revolving credit facility, basically, their bank line of credit, to cover the remainder.
And that's probably the other piece spooking the market, right?
Bingo. It creates this disconnect.
Yeah.
How can you be this amazing 71% FCF conversion machine printing cash
and yet still have to borrow money to pay off a known upcoming debt maturity?
Exactly. Management insists the balance sheet is strong. They have plenty of liquidity, including the revolver capacity. But the optics aren't great. It feeds that narrative of underlying financial stress, even if they say it's manageable.
Okay. That sets the stage perfectly for our This Is Not Financial Advice segment. Time to pitch an outrageous, but maybe plausible trade idea to our imaginary investment committee. Stock's around $4.89, down almost 38% in a year. What's the pitch?
All right, committee, listen up. Given this setup, I'm pitching a catalyst-driven long position on RPAY.
Okay, lay out the core thesis. Why long, despite the worries?
The thesis is simple. The market is overly focused on the noise and missing the signal. The signal is the cash generation. That 71% FCF conversion is elite.
And the noise?
The noise is the GAAP loss, which we argue is a one-time historical cleanup, and the temporary growth headwinds. The underlying operational engine is still humming. The stock price discount is just too severe relative to the cash flow.
All right, what makes this plausible, though? What stops it from just being a value trap?
Plausibility comes from tackling the risks head-on. The debt maturity. Yeah, it's there, but they have a clear two-step plan. Cash plus the revolver. It's manageable, even if it looks a bit awkward.
And the growth risk?
The underlying normalized GP is growing. It's not shrinking. And they've put money into the sales team. They're focused on the right segments like AP. The path to Q4 acceleration isn't guaranteed, but it's visible.
Okay, now the wild part. What's the aggressive bet here?
The aggressive bet is that they actually pull it off. We're betting on the new CFO, Robert Hauser, getting things buttoned up, and that enterprise sales investment finally paying off big time in Q4.
So bet on them hitting the guidance.
Exactly. Bet that they deliver that high single to low double-digit normalized GP growth in Q4. If they do, this whole wait-for-proof narrative instantly flips. The market breathes a sigh of relief.
And the stock reaction.
You can see a very quick re-rating, maybe 20%, 30%, as certainty replaces skepticism. So the trade is go long now, target maybe that Morgan Stanley price target of $5 or even higher, anticipating that Q4 delivery confirmation.
Got it. A bet on execution, proving the doubters wrong.
Summarizing it all, Repay's got this weird split personality right now.
Yeah.
Operationally strong, great margins, fantastic cash flow. But it's haunted by its past, both that big impairment charge and the looming 2026 debt.
So the whole H2 story, the acceleration promise, it rests entirely on management, proving those normalized growth numbers are the real deal.
Yep, it's all about execution now.
Which leaves the biggest question for you, the listener, to chew on. Repay generates cash like crazy, 71% conversion. Does the fact they need to tap a credit line for one specific debt payment really justify the stock being hammered this badly?
That's the billion-dollar question, or maybe the $220 million question here.
That tension is what management has to resolve, likely by Q4. That's all for this deep dive. We'll catch you next time.